Hi, hi. Good evening. Good evening, everyone. Join fast. Hi. So let's start with the topic. Okay. Big topic. Now, module B is completely big. You call it anything, module B is big. Let me put it like this. So, what is the risk? Now, what is the risk? This question is a difficult question in the sense. What is the risk? Suppose if somebody goes to the 10th floor of a building, 10th floor, okay? If somebody goes on the 10th floor of a building and plans to jump or jumps from that building, good evening, good evening. Somebody jumps from the 10th floor of the building, okay? Is there a risk involved? Everyone just answer one question. Somebody jumps from the 10th floor of a building. Is there a risk involved? No risk is involved. No risk. Okay? There is no risk involved when somebody jumps from the 10th floor. No risk is involved. No, 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 no risk. No risk is involved. Why? Because if somebody jumps from the 10th floor, he's sure to die. Okay? Somebody jumps from the 10th floor, he's sure to die. Somebody just goes and jumps from the running train. Is there a risk involved? No risk involved. There, because that person is sure to die. See here, understand the concept of risk. Understand the concept of risk. The concept of risk is firstly uncertainty. Something will happen or not happen. When such thing is there, then there is a risk. India will win the match or not win the match. Risk involved. Your share price will go up or won't go up. Risk involved. Okay? So risk is like this. Whenever there is an uncertainty. So risk is uncertainty is resulting in adverse outcome. Adverse, kindly understand. Adverse outcome. Okay? It should have a negative impact. Then only it's a risk. Having a positive impact, then what's the risk? Adverse outcome. Adverse in relationship to the planned objective or expectations. So, whatever you have planned, if it goes against you, against your planning, then there is a risk. Similarly, financial risk. Financial risk are uncertainties that will result in what? Losses or reduced profitability. Means your profit will be reduced. Both the things are risk. Either reduced profit or your losses. Either of these two things. So financial risk is related to reduction in profits or your losses. Okay. Now another question comes then. What we have said is risk is uncertainty. Now another question comes is what is uncertainty and what is risk? What is the difference between uncertainty and risk? Uncertainty means what? You cannot guess. You cannot judge. You don't know. It's on luck. Uncertainty is mainly dependent on luck. Okay, it may happen, it may not happen. Luck. But risk means what? It can be assessed. Calculations. You should have a calculation based approach. Then only it is called as risk. Okay, so uncertainty may happen, may not happen. You don't have any say or anything to do in that. Okay, so uncertainty is imprecise knowledge about the future events. On the other hand, risk is that kind of uncertainty which can be systematically assessed. Calculations through reasonably reliable probability distribution. That is all. Remaining thing is not required. Importantly, systematically assessed. So if you can do the calculations and do some judgment, take some calculated risk, then it's a risk. If you can't take the calculated risk, you are simply putting it on luck, then it's uncertainty. Okay, got it? Model B. Yeah. Okay. Everyone kindly note the classes timings for from 31 to 4. Okay, 31 to 4 I am not there. So the classes timings have been rescheduled. I'll give you the dates now. Chalo, hold on. Huh? I'll give you the dates. All of you are in the group, WhatsApp group which I have created. All of you are there na, in the WhatsApp group. Let me mark this pin for 7 days. Yeah. See, I pinned this comment, I think so. Yeah. See this. What are the timings of the classes? BFM, which is on 31/1, it will be done tomorrow, 26/1 at 5 p.m. So tomorrow you are having a class at 5 p.m. for BFM. Okay. Then BFM, which is on 1/2, means 1 February evening, that will be done in 1 February morning. Okay, 1 February morning. Then BFM class, which is on 3rd February, that will be done on 28th January, 7 a.m. So see this, 26 you are having the class in the morning. 26 tomorrow evening you are having the class. In the morning also you are having the class, I think so, 11 a.m. I had kept the class at 7 a.m. actually, but I told many students told me that you have to go for that compulsory flag hoisting. Okay, so that's why I've shifted it to 11 a.m. Okay. Also 11 a.m. we have a class. So yeah, 11 a.m. you have a class. So actually 7 a.m. I had put the class, but that 7 a.m. I have shifted it to 11 a.m. So two classes are there tomorrow, 11 a.m. and 5 p.m. Okay, two classes are there. Then you have the class on 27th. 27th, let me see. First 26th, 27th, ABM, huh? 6 a.m. 27, 7 a.m. 27th, you are having many classes. Huh? 27th, you are having two classes. 6 a.m. to 7 a.m. regular ABM and 7 a.m. to 8 a.m. again ABM. So 27th also you are having the class. Okay, so 27th regular class is there, 6 a.m. and at 7 a.m. also you are having the class. 28th, you are having the BFM class at 7 a.m. Means 6 a.m. is there. Regular class ABM will be there, 6 a.m. to 7 a.m. After that, you'll have 7 a.m. class, 28th. And at 29th also, you'll be having the class at 7 a.m. So basically, 27, 28, 29. All the 3 days you are having an extra class at 7 a.m. in the morning. Okay? 7 a.m. in the morning, extra class. Regular classes will continue as they are. Okay? Up to 31. Got it? Chalo. Let's move on now. Because 31, 1, 2, 3, 4. 4, I think so. 4 I'll be there. 31, 1, 2, 3. 2 is holiday, isn't it? Yeah, 2 is Sunday. So 31, 1 and 3. You won't be having the class. In the evening also, in the morning also. Chutti, aram. Not aram, padai karo. Not aram. Okay? But I'll be there. I'm going for Kumbh Mela. So 144 years. That's why. Chalo. So all of you have joined the group, it seems, right? So risk is systematically assessed. Now, what were you buying lottery, uncertainty or buying share risk? No, buying lottery is basically uncertainty because you don't have calculations, Ganesh, right? Yeah. Extra class is also continuation. Same topics will continue. Okay, in WhatsApp group. Okay, I've just now posted it in the morning also. But remember, here everyone remember the thumb rule. 27, 28, 29. You are having a class at 7 a.m. along with your regular classes. Okay? You don't who all are not there in the group? Those who are not there in the group, kindly take this link and join it ASAP. Okay? See this. Take this link and join the group. See this. I think what I'll be doing is from tomorrow, we will be starting a competition in the group. Competition in the sense, not a competition. We'll be having some questions. I'll be asking you some questions on a daily basis. 2, 3, 4, any type of any number of questions. I think so 2 ABM, 2 BFM. So I'll be asking you 2 questions in the group, and you have to answer that. So everyone has to do that. So it will be a huge practice. So roughly 4 questions per day means around 30 days means 120 questions for ABM and BFM. So huge. It's a good revision as such. Okay. Yeah. Let me see. You have said hi in the group. Hold on. Yeah, Sunanda, I got this message from you. Sunanda only, na? Yeah, I got the message in our account. It's not yet updated. Okay, I'll check this. I've already written to the Adda guys. Okay, let me write it again to them. Otherwise, what happens? They'll forget it. One sec. Chalo. Yeah. So, yeah, they'll update it. Now, second, uncertainties associated with the risk elements impact the net cash flow. Okay? Cash flow means either positive or negative. Whenever you have a positive cash flow, it's always good. If it's negative cash flow, then only you have a problem, right? So impact the net cash flows of any business or investment. Under the impact of uncertainties, variations in the net cash flow takes place. There could be favorable as well as unfavorable. Means variation means if there is an unfavorable impact, then there is a risk. If there is a favorable impact, then it's good. Suppose if I expect I must get a return of let's say 20%. Okay? If I expect the return of getting 20%, if I'm getting 30%, then there's no risk. But if I'm getting 10%, then there's a risk, isn't it? Lower risk implies lower variability in the net cash flow with lower upside and downside potential. Now, lower risk, lower variability. Now, all these things you need not even learn this, I will say. If you go by my logic, you need not even remember this. Why? Because the logic is very simple. You have to only remember one line, that is high risk, high returns. Okay? High risk, high returns. Okay? So what does it mean? If I'm having lower risk, then I'll have low returns. If I'm having higher risk, then I'll have high returns. If I'm having zero risk, okay, then no variation. So returns are very low. If I put my money in Nationalized Bank FD, then there is zero risk, though no variation, right? So lower risk implies lower variability in cash flow with lower upside and lower downside potential. Higher risk is opposite. It will require higher upside and higher downside. Okay? Zero risk means no variation. Returns on the zero risk investment would be low as compared to other instruments, isn't it? If I invest in FD, I'll definitely get lower returns, isn't it? Yeah. I'll send you tomorrow. I'll send you at night. I'll send you the classes, complete classes, huh? In the group only, I'll send you. Now, linkages among risk, capital, and return. Linkage. What do you mean by this? Very simple. See this: risk, capital, and return. These are the trinities, they call it. What is trinity? Trishul, Tridev. Okay, trinities. So these are the trinities. The whole business, kindly note, one line you must always remember throughout your life: risk, capital, and return. These are the only three things in your life. Only three. Nothing else is there in your life. Risk, at least, means I'm not talking of relations. Relationship is different. In business and money, only three things are there: risk, capital, and return. If you want high risk, then you'll get high returns. But you'll require higher capital because capital will also increase. Because the risk is more, you'll have to put in more money in this. Low risk, low returns, but low capital. See this over here. Okay. Minimum trinities mean Tridev. Okay. Minimum capital required for the business should be such that it is able to meet the maximum loss that may arise from the business to avoid bankruptcy. So lowest capital invested should give me the highest loss bearing capacity. That's what we think, isn't it? Minimum capital should give you the should bear the maximum loss. What do you see? How do you see this? Minimum capital invested should give you the highest loss bearing capacity. Where do you have this? Where do you have this? This you have it in insurance. Why do you pay insurance premium? You tell me, all of you. Why do you pay insurance premium? Because you expect that if something happens to me, my family will get what 10 lakh, 20 lakh, 50 lakh, whatever it is, right? That's what you expect. For that, what do you pay? You pay a lower amount, premium, isn't it? So, got it? Basically, it's here lowest investment and highest risk cover. Okay, so that is who wanted is Viresh. Everyone else, those who have joined new or those who are not there in yesterday's class, take this BFM PDF. Okay, this BFM PDF includes all your BFM, complete BFM. Go for this, read this PDF, download it, and read it. Okay, so coming back to this, risk minimization, correct, risk minimization at lower cost, that is also important. If let's say tomorrow the insurance company charges you, you wanted the risk cover of let's say 50 lakhs, we will charge you 30 lakhs. Give us 30 lakhs, then we will pay you 50 lakhs if something happens to you. Will you give it? If tomorrow insurance company says, give me 30 lakhs, then whatever happens to you, I'll give you to your family 50 lakhs, 60 lakhs, whatever that amount is. Will you give? No. 30 lakhs is a huge amount. So, what you try to do is minimum investment, right? Minimum investment, and then you'll get the maximum returns or basically risk cover, isn't it? This Sushil, that PDF is this BFM, complete BFM PDF. Okay. So, coming back. So, basic logic, remember from exam point of view also. Remember, you'll definitely get one question on this risk, capital, and return. High cash variations, high risk, high profit, high loss, high capital requirement. Everything high, high, high. Low cash variations, low risk business, low profit, low loss, low capital requirement. Clear? Low, 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 everything low. Why risk needs to be managed? Risk means what's here? If you don't take the risk, then you can't do anything in life. It's that simple. If you want to do anything, you have to take the risk. But you have to take the calculated risk. That's what is called as managed risk. Managed means you can manage the risk. Risk management creates an imperative to develop the methods to measure risk so that an organization is aware of the risk it is carrying for its business. Means you should be able to measure the risk. Okay, methods to measure the risk. You must be able to calculate how much do I invest, how much are the returns. You must be able to calculate this. Okay. aware of the risk it is carrying in the business. Every company must know what is the risk in its business. Okay, it has a measure of potential losses. It has a measure of potential losses of its losses in severely adverse conditions. Means if everything goes wrong, then do I have a fallback? This fallback comes from your tier 1, tier 2, and tier 3 capital. Okay, may ensure adequate capital availability for continuance or limit its exposure to the extent of capital available. Basically, it means what? I must have minimum capital requirement. I'll invest minimum capital so that it covers maximum losses. Okay. Again, the same logic of insurance. Minimum premium I'll pay so that insurance cover is I receive is higher. Now, one important point. See, these all terms I'll be explaining you later. ROC, return on capital. What does this mean? Return on capital means how much have I invested, how much am I getting the returns. That is ROC. Okay. Then what do you? The next point which you have is how to cover this risk. Businesses cover this risk through the capital, tier 1 and tier 2. Tier 1 is known as own capital, going concern. Tier 2 is known as a borrowed capital. Okay. Then you have a term called as RAROC, risk adjusted return on capital. What is RAROC? This is an important term in risk. ROC means what? Return on capital. Whatever I've invested, how much returns I'm getting. If I invested 1 lakh rupees, I'm getting 20,000. So my ROC is what? 20%. 20,000 upon 1 lakh. 20%. But to get the return of 20,000, if I'm paying, let's say, means I'm getting the return of 20,000, but the inflation in my country is 5,000, means 5%. Means it is eating 5% is the inflation. So it is eating 5,000 of mine, 5% of 1 lakh. So 5,000 of mine is going. Why? Because of inflation. So what is my return then? Is my return 20,000 then? No, because 5,000 is going in insurance. So this remaining amount, 15,000, is known as RAROC, risk adjusted return on capital. Whatever is my risk, that I'll have to adjust. Inflation is to be adjusted. If I'm paying for the insurance, then that is to be adjusted. These are all the costs which are required for the growth. Okay. Overestimation of losses on account of risk may result in overpricing, and that will result in loss of the business. Right? Means basically, if you consider you all are in banking. Okay. Suppose if from tomorrow you start saying that these loans is very dangerous business here. We give the loans, then the customer doesn't pay, NPA might happen. That's why what we do, we will increase the rate of interest because the only good customers will come, higher rate of interest, only rich customers will come to us. If the rate of interest is 8.5, now we'll make it 10%. We'll increase it by 1.5%. In that case, what will happen? No customer will come to you. No customer will come to you. Okay. RAROC, you are having the explanation again. Okay. Risk adjusted return on capital. Whatever is the risk premium you are paying, insurance you are paying. Okay. Let me take one better example in RAROC. Suppose you are starting a business. Okay. A new business you want to start. For that, you expect that you will be getting, let's say, per month you will be getting 50,000 rupees from that business. Per month, 50,000 rupees. You are getting that. You are having that calculations that 50,000 I'll get. But if there is some error, some loss, then you might lose, let's say, some 10,000 rupees. Okay, if you face any problem in that business, then that 50,000 might go down to 40,000. There's a loss of 10,000. So what is your ROC? ROC is 50,000. You are expecting the return of 50,000 per month. But what is your RAROC? Risk adjusted. So risk, what is the risk amount you are having, Vaishalini? What is the risk amount you are having? 50,000 was your returns. Risk is 10,000. It might go down by 10,000. So your REROC will be what then? 50,000 minus that risk. Okay? 50,000 minus that risk. So your REROC will be 40,000 and your ROC will be 50,000. Understand the difference, everyone. Okay? ROC is full amount, REROC is subtract the risk amount. Whatever insurance might be there, inflation might be there, anything might be there. You have to subtract that this risk amount. Okay. Now the next point is overestimation of risk. If I overestimate the risk, means what? I'll say that all customers are bad. All the loan customers are bad. Increase the rate of interest by 2% for all. No customer will come to me. I'll have to close down the business. So overestimation will result in overpricing and nobody will come to me. Reverse. I'll say that all are good. Very good customers. Give them at lower rate. 8.5, make it 6.5. Give them at 6.5. Underestimation may result in lowering of profit. Where is the profit? If you are giving it at 2% lower, where is the net income for you? So underestimation will reduce your profits. Okay, losses, correct. Management of risk is a major concern of the top management. Management of risk begins with the identification and qualification. Now, what do you mean by identification? Identification is okay, you'll understand this. Identify the risk. What is identify means? How will you identify the risk? How does one identify the risk? Let's say you are in the bank, in the top management. Okay? What is the risk you will be facing? See here, I'll tell you the risk. There are various risks. At the top level, always the risk, there are two risks which the top management is always concerned about. One, it is always concerned about market risk. Very much. Market risk. Huge. Top management is always concerned about this market risk. Second risk is strategic risk. Strategic means long-term risk. Long-term, yes, reputational. Correct, Sanjay. Long-term risk and reputational risk. Okay. We use these three risks the top management is always concerned about. Market risk, strategic risk, and reputational risk. Very important. Tomorrow something comes in the newspaper or on any web portal about your company. Immediately the shares go down. What you saw that Adani Hindenburg issue? What happened? Hindenburg closed. But at that time it caused a loss to Adani. Ultimately Hindenburg closed. But at that time what happened? At that time when the issue was there, Adani faced losses. Strategic risk is also important. What is strategic risk? Strategic risk means basically long-term planning. You see that Nokia company, Nokia, all your phones in 2008, all of you might be having some phones in 2008, 8, 7, 5 to 8, roughly in that range. Roughly about up to 10, chalo, 2010. All of you are having some phones, even I think 2013 also I was having that phone. No, 8, 10, 11, yeah, up to 11. Up to 10, 11, we are having those phones. You know those phones? Nokia was there. BlackBerry was there. There was one phone called as BlackBerry. Anyone remembers BlackBerry phone? Very status symbol. If somebody had BlackBerry phone, my God, it was like, oh my God, BlackBerry phone. Correct? So this BlackBerry phone, Nokia phone, where are these now? Have you seen any Nokia phone in last 6 months? Have you seen any BlackBerry phone? Correct. Okay. So risk means correct. Dalda, Nirma washing powder, correct. They are not existing that much now. Okay. So same thing happened. Correct. Means you don't think whatever is coming up in future. Okay. You don't know whatever is coming up in future, and you don't change yourself. Nokia didn't change itself. That's why I got out. Okay. No, don't take. Pragya, I will always suggest you take RBI option if working in RBI. If you're working in RBI, then it's okay. If you are working in RBI, then it's okay. Otherwise, don't take. See, here, central banking, I am teaching you. I myself do take this central banking elective. Okay. I'm having your around 600 questions of your central banking. Okay. So the paper comes from there only. So there's no problem as such, but the topic is very difficult. But if you are working in RBI, then it's okay. Are you working in RBI, Pragya? If you are working in RBI, then no problem. Okay. Chalo, move on. Okay. Yeah. Identification and quantification. Yeah. Risk management happens to be a job that requires special skills. Okay. It is available. Everything is available. In Mahapak, all the electives are available. Okay. Chalo, move on. Risk management happens to be a job that requires special skills. Special skills, huh? Remember. Now, what are the special skills which are required? See here, in risk management, you must always be open to, means open with your eyes and ears. You should always think whatever is coming in future. The three risks which I told you: reputational, strategic, and market. Always very important. See here, remaining risks you can definitely control. Now you'll see many risks. Now, not today, but in some days you'll be saying many risks. So all these risks will be means all of them can be controlled, but reputational, market, and strategic very difficult to control. Areas of risk management. What are the various areas? Areas means what? Basically, how to identify this risk and organize this risk. Identify the risk, measure the risk pricing, monitoring and control, and risk mitigation. So these are the 5 steps: identify, measure, pricing, monitor, and mitigate. Okay? Identify the risk, measure the risk, price the risk, monitoring and control, and mitigation. Okay? These are the 5 steps. Now, in exam, what question do you get? You get the question for arranging them in serial order. Arranging in serial order. Huh? You have to arrange them in serial order. They'll give you a jumbled one. Some monitoring will be first, measurement will be last, mitigation will be in between. You have to understand. First, you identify, then measure, then price, then monitor, and then mitigate. Mitigate means what? What do you mean by mitigation? Remaining words are easy. Identify, measure, price means add the pricing. What is pricing? Okay, let me explain you pricing also. Pricing means what? See this. Simple logic. There is a customer A, there is a customer B. Okay, there is a customer A, there is a customer B. Customer A is having a CIBIL of 800. Customer B is having a CIBIL of 500. So whom will you give higher rate of interest? You will give it to B, isn't it? A will be having 800 score, so his rate of interest will be 8% on loan. And for B, it will be 10%. Why? Because he is having low rate. So that is known as risk pricing. Why this extra 2%? Extra 2% because you are risky customer. That is known as risk pricing. Okay. Then monitoring and control. Now look at this. Monitoring and control. How to monitor and control the things. Now important part over here is in monitoring. Monitoring means daily monitoring at the branch level. At the branch level, you have to always monitor using what? Stock statement. Whenever the customer comes to the branch, means CC customers, the customer submits a stock statement. You have to check that stock statement, whether it's matching with the given projections. That is monitoring. You have to check the fund transfers of that CC customers. See here, monitoring is very important in cash credit. Very important. Because in that what happens, yeah, SMA accounts, correct. SMA accounts also to be monitored. So that is basically in CC you have to monitor very keenly. Control means what? Control is at the HO level. See this, control is at the HO level. In control what happens? Now, here, control can be at branch level also, obviously. Here, control can be anywhere, HO and branch. But the point over here is, in branch level, how do you control the risk? In branch level, you'll take 2, 3 steps. What steps you take in branch? Number one, you will check the financial analysis of that customer. Financial, management, all these analysis you will do. Proper KYC, correct. Okay. Other steps, you will take the collateral so that if tomorrow the loan fails, you can sell that collateral. So these things are done at the branch level. What at the HO level, what do you do? At the HO level, you to do 2 things. Very important 2 things are done. Which are those 2 things? At HO level, we first step what we do is diversification. We never give all the loans. We never give all the loans to the same sector. Means I'll give all the loans to my IT industry only. Tomorrow, if IT industry fails, then so that's why RBI has also given the instructions to the banks that you should not give more than correct in one pocket. Correct, Sushil. RBI has also given the instruction you should not give more than how much percent of the loan of your tier 1 capital? Can anyone tell me? How much percent of the loan is not allowed to be given above something of the tier 1 capital? It is 10%, correct? You can't give more than 10%. No, first is 10%, then it's 20%. Okay? 10%, no, 10% and 20%. Tier 1, 10% to individual company. And if it is a group, then it's 20%. Okay? Yeah. Concentration risk. Correct, Kamlesh. Very good. Concentration risk. Okay? So, got this point, control is done. Mitigation. How to mitigate the risk? What is mitigation? Mitigation means, I'll tell you one important part. Mitigation here, there are 3 words in which all of your banking revolves. Complete banking of yours revolves on 3 words only. What are these 3 words? Do you know? One is hedge. Second is leverage. Okay? Hedge, leverage, and third is arbitrage. Very important words. I think so. I have given you in module A also somewhere. Those who are new, so kindly understand. All of your banking revolves around 3 words only: hedge, leverage, and arbitrage. Full banking, full. Not only banking, all the financial world, complete financial world moves around these 3 words only: hedge, leverage, and arbitrage. You do anything in banking, you do anything in finance, you are doing either of these 3 words: hedge, leverage, and arbitrage. Okay? What is hedging? Hedging means mitigation, reduction in risk. How do I reduce the risk? Reduction in risk is done by derivatives. Derivatives will allow you to reduce the risk. Very important. Okay? What is leverage? Leverage means overbuying. Overbuying. Okay, let me explain you. One by one, hedging, you got it? Means, suppose if I buy insurance, I'm buying my car, I'm having a car, and I buy insurance. Why do I buy insurance? To hedge the risks. Tomorrow, if the accident happens, then that insurance company will pay me. That is basically hedging the risk. Hedging means reducing the risk. Leverage means what? Overbuying. What do you mean by overbuying? Okay, I'll give you a very simple example. Amdani athani kharcha rupaya. That sentence we have na in our Hindi language. Amdani athani kharcha rupaya means your income is 1 lakh rupees and you are spending 2 lakh rupees. How can this happen? Can somebody do it this way? Leverage. Can somebody do this over expenditure? Yes, you can do it. How? I'll give you a very simple example. I take a home loan from you. No. I take a LAP from you. LAP means what? Loan against property. I'll take a LAP from you. I'll give you a mortgage of, let's say, one house I'll give you of 50 lakhs. I'll give you a mortgage. You will give me against that property, let's say 70%, 70% you will give me roughly. So 50 into 75% means 35 lakhs. You will give me that loan. What will I do? Now look at this. What am I doing? Leverage. How am I doing the leverage? Okay. By that 35 lakhs, I'll buy another house. Again, put it with you as a lap. Again, you'll give 70%. So 35% into 35 lakhs into 70%. Again, I'll get a loan. Again, I'll buy a next house. Put a leverage. So what am I doing? From the same property, only one property of 50 lakhs. I'm buying so many properties and everything is on loan. Right? So the important part over here is, remember, what you have to do is this leveraging you have to always avoid. Okay? Even RBI does the leveraging. To be frank, what is CRR? CRR is actually leveraging. Okay? In CRR, what happens? I am having a rupees 100 deposit. 10% is my CRR, let's say. So 90% is the amount which I can give it on loan. So that 90% goes to some other bank as a deposit. So that bank, again, what does it do with that 90 rupees? It does 10% over there. It takes removes 10% as CRR and 81 rupees again loan. So this goes on reducing till it becomes zero. So that is leveraging. Okay. Arbitrage means what? Buying in one market and selling in another immediately. Buying in one market, selling in another. Okay. So that is arbitrage. Everyone does arbitrage. Okay. Yeah. Too much leverage is very risky. Correct. So arbitrage means buying in one market and selling in another. So remember these three words. Okay. Move on. Risk pricing. Risk in banking transactions impacts banks in two ways. First, banks have to maintain necessary capital. What is this capital? Where do they maintain the capital? See, there is a Basel norm that's called a CRAR ratio, capital to risk weighted asset ratio, or they call it CAR also, capital adequacy ratio. Two ratios are there, CRAR or CAR. Okay, formula is same. There are three names to this: CRAR, CAR, and there is one more name. That name is known as Cook's ratio, COOKE, Cook's ratio. So these are the three names to the same formula. So this ratio is capital upon RWA. So first you have to maintain necessary capital. What is RWA? RWA means loans. How much loans you have given. Okay. So loans, capital upon loans. Okay. First you have to maintain the necessary capital so that the ratio is maintained. At least as per the regulatory requirements, the capital required is not without costs. So this capital which you get, this capital, how do you get? There are two types of capitals. Kindly note, tier 1 and tier 2. Tier 1 means shares. Shares, reserves and surplus, revaluation reserves, net profit. These are all T1 capital. These are called as free capital. Free, T1, free capital. This is also called as going concern. See, this is also called as going concern. Going concern. Okay. So T1 free capital, going concern. T2 is paid capital or called as gone concern, gone. T2 capital means it is brought on loans. What do you mean by this? Let's understand it better. T1 and T2. Okay. Suppose let's say you are having 10,000 rupees in your pocket. You are having 10,000 rupees in your pocket. Okay. You are going somewhere. 10,000 rupees are there in your pocket. Unknowingly, these 10,000 rupees fall somewhere. You don't know. Where did it fall? You don't know. Where did it fall? You don't know. Okay. What will happen? You will cry for one day or 10,000 gaya. Feel sad. Maximum second day also you will feel sad. Third day you will feel a bit okay. And from the fourth, fifth day, you will start working your normal life. Okay? When this 10,000 is yours, imagine you have taken a loan of 10,000. You have taken a loan of 10,000 cash. And now this 10,000 falls. Now the 10,000 falls. Now what will happen? Number one, you will cry, sir, 10,000 gaya. 1 day, 2 day, 3 day, 4 day, same logic will happen. But there is number two thing happening. What is number two? You have taken a loan from somebody, let's say a bank. That bank will call you on a daily basis. Huh? Oh, 10,000 loan liya tha, EMI. What happened? Now you will have a double headache. One, your money is gone. Second, the bank is troubling you. Isn't it? That is T1 and T2 capital. Tier 1 means always your own money. So if it is lost, then also you feel sad for some time, but not for a longer period. Nobody will catch and put a gun on your head that give me my money back. But T2 capital, if you lose, somebody will come and put a gun on your head. It can be bank or it can be anyone. Right? So that is the difference between T1 and T2. T1 is your own money, free capital. T2 is a paid capital, loans taken from somebody. Okay. So coming back, so it will impact risk. Risk will impact the banks in two ways. Banks will have to maintain the necessary capital, at least as per the regulatory, and it comes at a cost. Obviously, means loan comes at a rate of interest, isn't it? The cost of capital arises from the need to pay the investors in banks equity in form of dividends or from internal generations of capital necessary for business growth. Okay? Necessary for business growth. Okay, yeah, Sushil, your question is right. What is gone concern? Okay, now this is a very, I was not going to explain you right now this point, going concern and gone concern. But as you have asked the question, I'll explain you now only. What is going concern? What is gone concern? What is the meaning of this? Going concern, gone concern. See here. What is going concern? Firstly, understand this. Going concern. I've written it over there now. Sushil has asked me a right question. That what is going concern then? Gone concern. See this. The question is like this. Okay? Yeah. It will be with you for forever. Means what? Forever means what? Suppose, say this. Same logic again. Suppose I'm a big company. Okay, let's say I'm Reliance. No, let's not call Reliance. Some big company, XYZ big company. I will not name any company. Okay, because there is a bad element involved in gone concern. Understand this. There is a very bad element involved in gone concern. Okay, what is that? I'll explain you. If there is a big company XYZ and it suffers a loss, if it's having tier 1 capital, huge amount, then this loss it can bear. It's their own money, na? So they won't be facing any problem. But if they don't have their own money, if they have bought a loan, taken a loan from anyone, bank or private parties, anyone, and then they lose the money, then what happens? Then the company goes into bankruptcy. The company gets down, dissolves, bankruptcy. Gone concern capital comes in picture when the company is bankrupt. This is a very important line. Gone concern comes in picture when the company becomes bankrupt. Means what? You'll have to pay the banks by selling your assets. Whatever your assets are, na, you'll have to sell it and then give the money to the bank because you have gotten bankrupt. You don't have money. Isn't it? So that's why gone concern is called, tier 2 capital is called as gone concern. Why? Gone means company is gone. Understand the meaning. Gone means actually company is gone. That's why Sanjay, what you gave is right answer. Not living forever. Company is not living forever. Going concern means living forever. Company is living forever. That's why I didn't give the name of any big company because bankruptcy is involved in this. Okay? So coming back to this point. So the cost of capital arises from the need to pay the investors in banks equity in form of dividends or internal generation of capital necessary for the business growth. And for internal generation means what? See here, if you get the capital through shares, see T1 capital. T1 means you get it through shares and reserves and surplus and revaluation reserves and net profit. There are four elements in T1 capital: shares, reserves and surplus, net profit, and revaluation reserves. So this is the going concern, free capital. But actually, I'll tell you, this is also not free. T1 is also not free. Why? To issue the shares, you require some money. You need a IPO. IPO will cost you something, isn't it? To do this reserves and surplus, to get this net profit, you are required to spend something on the salaries of the persons. So that's why nothing is free in business. Only the point is the money which you are having excess of yourself. Even if you lose it, you are not that much worried. That is the meaning of this. Otherwise, T1 is also in some way this having cost. T2 is but obvious having the cost, isn't it? T2 means what? Paid capital. You are getting the loan from somebody. So definitely you'll have to pay the interest. Okay? Each banking transaction should be able to generate the necessary surplus to meet the cost, isn't it? Every banking transaction should be able to generate the surplus. Then only it's of any use, isn't it? Otherwise, what's the use of doing business? If I am not generating the surplus, then why am I doing the business? In your bank only. If you are not getting NII, net interest income, what is the net interest income? That is called a spread. If you are not getting NII, then why are you doing the business? Simple. We are not here for philanthropy. Philanthropy means benevolence, we call it. Benevolence means dan dharam. Jao leke, jao leke, jao leke. We are not here for that. We are in commercial business. Banking is a business. So similarly, we will be having NII, net interest income. Your loan income should always be greater than your deposit expense, right? So that is basically the point which you have to say, which you have to see. Correct? NIM minus cost. There are two things. Kindly note here, everyone. Kindly note the difference between NII and NIM. All of you might be thinking that NII and NIM are same. Very different. NII is different than NIM. Kindly don't mix these two with each other. NIM equals to NII divided by your yielding assets. Whatever your loans are there, assets means loans. NIM equals to NII upon loans. Keep it very simple. That is NIM. NIM is the ratio of NII and your loans. And NII is what? NII is very simple. Your loan interest minus your deposit interest. Whatever the difference is your NII. Minus that cost. Obviously, you'll subtract the salary expenses and all these things. Okay? Salary, electricity, everything is subtracted. So that is the basic logic. NII and NIM are two different things. Okay? Don't mix them. Chalo. Let me see what is the next. Let's call it tomorrow only. Tomorrow we are having a class, I think so, at 11 a.m. 11 a.m. Let me see, is it of ABM or BFM? Let me check. Hold on. Yeah, ABM. Okay? BFM, sorry. BFM class is there tomorrow. Okay? 11 a.m. So same topic will continue. Okay? Yeah. Social, yes. Payable and expenses. It's a subtraction actually. Received minus expenses. Social, it is interest received minus interest paid. That is NII. Chalo, bye everyone. Tomorrow let's meet at 11. Okay? One second. What is the question you are asking? Hmm. No, yaar, I don't know what is this pixel. I really don't understand the technical terms. I understand only this camera. Something might be there. I don't know, yaar, in this. What धनंजय, what is your question? बैंक के केस में टीयर टू कैपिटल डिपॉजिट होगा. वन सेकंड. डिपॉजिट होगा क्या? मीन्स बैंक के केस में टीयर टू कैपिटल डिपॉजिट होगा क्या? मीन्स यू आर आस्किंग दैट बैंक में डिपॉजिट जो हम लेते हैं तो टीयर 1 में आएगा कि टीयर 2 में आएगा, ऐसा आपका क्वेश्चन है. बेसिक मुझे ये लग रहा है, राइट? देखिए उसमें क्या होता है कि इन दिस, ओके, एवरीवन काइंडली अंडरस्टैंड व्हाट इज डिपॉजिट, व्हाट टाइप ऑफ कैपिटल इज डिपॉजिट, टीयर 1 और टीयर 2. ओके, द डिफरेंस इज लाइक दिस. Every bank has to check in your deposit percentage, whatever, suppose if you are having a deposit of 100 rupees, okay, in that 100 rupees, let's say CASA, current account saving account, you are having the deposit of 100 rupees. In that 100 rupees, you have to check for last 10 years how much CASA is stable, which is not going out from your bank, and how much CASA is fluctuating. Whatever is a stable component, that is considered as tier 1 capital. And whatever is the fluctuating component, that is considered as tier 2, volatile component. Okay? Pixel. So that the picture quality is more maybe in HD. Okay. I'll speak to these guys here. I don't know. This is the camera which they have given me. This Adda guys have given me. Okay? So I'll speak to them whenever I'll get time now on this. Okay? Chalo. Bye everyone. Tomorrow let's meet at 11 a.m. Okay? Good night.